Hi, how are you doing? Mathis here with Connor Management Group, and this week we're here to look at another stock, and we're going to look at an overvalued stock to sell, a stock you can short or you can buy a put option on, basically betting that it goes down. So this week, today is Thursday, November 27th, 2013. And this week we're looking at a company called Strayer Education. The ticker symbol is STRA. The industry is education and training services. And we see this company is having a 12-month downside potential of negative 34%. So some of you may have just heard through, the media. This is Strayer University. They advertise on television. I've heard them every once in a while. So their business, some of their quick facts. Strayer Education, through its subsidiary, Strayer University, provides post-secondary education services for working adults. It offers undergraduate and graduate degree programs in various fields of business administration, accounting, information technology, education, health services administration, public administration, and criminal justice. The end of last year, they had a little over 50,000, I think 51,000 students. But as we'll get to in the presentation, the demand for new students is definitely weakening. The website is www.strayereducation.com, STRAYER education.com. Strayer is headquartered in Herndon, Virginia. They were founded back in 1892. They've been around quite a while. And the number of employees is 2019. So, a decent sized educational facility, but not huge, with just 2,000 employees. The ticker symbol is STRA. As mentioned, the sectors and services, industry, education, and training. The annual revenues for the last 12 months has been $521 million. The net income, $52 million. And the cash from operations also for the last 12 months has been $97 million. Now, the market capitalization of Strayer is just at $403 million. You could quite easily argue that this is a small cap company, educational company. Their products and services. Okay, here's their products and services page. On this page, as it seems to be with most educational facilities, there really isn't that much to show. There's a logo here saying Strayer Education Inc., making education achievable for working adults. This picture of three people sitting evidently at graduation. Some pictures of the top three executives. The executive chairman's name is Robert S. Silberman, and they have a map of where the majority of their campuses are. They quite a bit of their program is online. I mean, officially they state that they have over 100 campuses, but I imagine some of those are pretty small satellite locations. Also, we have here is just once again a listing of their degree programs that they say offer real world skills and high demand fields, and we just read through what those things are, primarily business related fields. On to the next slide. Some of their metrics, as mentioned already, their annual revenue is $521 million, net income $52 million. The operating margins are declining. In 2012, the operating margins were at 25%, and this year they're tracking to be 22%. So, and once again, the cash from operations is $97 million. On to the valuation metrics. Now, the trailing PE ratio, price to earnings ratio, is presently at 8.0, and the forward PE ratio is presently at 17.0. So, you never go long or try to buy a company where the forward PE ratio is greater than trailing, because basically it's telling you that the earnings are getting smaller or projected to get smaller over time. So, why would you expect to buy a company? In that case, you really want to short it, which is, what we're recommending. So the the PEG ratio is at 0.7, not overly rich, less than 1. The price to sales ratio, similarly, at 0.8. The price to book is at 7.1. And the enterprise value to EBITDA is at 3.8. So, all these valuation metrics, they don't suggest that it's an expensive company, but the projected earnings suggest that things are going to get more painful for them. So right now, would you say like, oh, this is a rich company? No. But, with the earnings shrinking, there's just pressure on the stock to go down further in price, in our opinion. Additional metrics. The recent closing price was $37.01, and the 52-week low was $36.50. So they're not too far from the low, and the 52-week high for Australia was $64.70. So we're quite a bit of ways from the high, and similarly you can see this relationship in the moving averages. The 20-day moving average, which is the most recent time period, has been $37.88. The 50-day moving average is at $40.87, a little more, and the 200-day moving average is $46.39, even more. So that's just consistent with a company whose stock price has been declining over time. The average volume for Australia, it's not a very liquid company, but it's traded fairly well. The average volume is 226,000 shares per day, and the beta is 1.43, meaning that it tends to go, when the market increases, this tends to go up a little more than the market in price. Similarly, when it goes down, it tends to go down a little more than the market price at 1.43. The dividend yield is presently at 0%. Australia cut its dividends for 2003. I mean, in 2012 and 2011, they paid a respectable dividend, 4.8% 2012, and 3.5% was a dividend yield in 2011. So, when a company cuts its dividend yield, that means things are pretty tight, because that's something you try to maintain at all costs. But when your financial situation is not looking good, that's one of the things that go. The stock chart, Australia's stock chart. The Australia's stock chart is just a reflection of the numbers we talked about earlier. Back at the end or beginning of February, the stock was up near $65, and then it declined fast, and at May the stock was around $45, and then it bounced back in June to around $55, and then it slid down to $40 by September. It made a recovery, jumped up to $50 around early November, and then came, I don't want to say crashing down, but came down pretty hard and fast to now here in late November to around $38. So this company is steadily been declining, and we just think that's a reflection of their earnings outlook. I mean, the unemployment is still high. People aren't overly optimistic about the employment situation, so the demand for Australia services is declining as well. So, we're taking a look at the financial statement quality of Australia. We classify that as fair, and that is just, it's supported by the fact that they had to cut their dividend, and their financial statements, I mean, they're not terrible, but they're definitely not good. So we classify that as fair. The operating margin trend, it's already clearly declining. The price pattern trend, it's bearish. It's also declining, and the model overall market outlook in general, we're still bearish. We still see more overvalued names than undervalued names. So we see this as an expensive market, and still wouldn't be surprised by a pullback. Coming back to Strayer, once again, the recent closing price is $37.01. Our model's 12-month price target for Strayer is $24.40. So that puts the company's 12-month potential at negative 34.1%. So we don't see how this company is going to go up in price anytime soon. And we think it's a profitable opportunity if you're the kind of person that would short a stock or would buy a long-term put on the stock. So that's another opportunity here for Strayer Education. We like to point out long opportunities that can be profitable, as well as short opportunities that can be profitable. So that's what we got for Strayer, and that's what we got this week. On to Connor Management Group. If you haven't already, please sign up for our Saturday morning update / newsletter. You hear about a lot of great opportunities like this one each week. And these opportunities are driven by our own self-developed proprietary algorithms. We're new on the block, and we tend to show everyone just how good we are. So just go to www.gmcstockpicks.com and sign up, and don't miss out. And if you want, you can always unsubscribe with just one click of the button. All right, that's all we got for this week. Take care. Talk to you soon.